So, Joey Group on 1 December 2023, Joey acquired 80% of Houghton $600 million $1 equity shares in exchange for cash of $750. The carrying amount of the Houghton's net assets at the acquisition date was $960 million. Joey determined that the fair value of 20% non-controlling interest in Houghton at that date was $250 million. It is the group's policy to measure non-controlling interest at fair value. Joey recorded a goodwill asset arising on acquisition of Houghton of $40 million, being $750 paid plus NCI minus net assets of $960. However, shortly after the acquisition date, the accountant of Joey realized the following. Joey. All right. Okay. A deferred cash consideration of $50 million arising on the acquisition of Houghton had not been recorded by Joey. This payment is due on 30 November 2025. So it's important to take note of the dates. An appropriate discount rate is 10%. The fair value of Houghton's identifiable net assets has been calculated to be $980 as at 1 December 2023. Oh, sorry. Rumbi, hi.
Hello, sir.
Right. It has been calculated to be $980 at 1 December 2023. The excess of the fair value. Okay. Sorry, Rumbi, I'm in a lecture. I'm in a lecture. I saw your. Hello, I am in a lecture. It's okay. I will connect you. Don't worry. I saw your Skype. Yes, I saw your Skype connect request. Okay. The fair value of Houghton's identifiable net assets has been calculated to be $980 as at 1 December 2023. The excess in the fair value of net assets over their carrying amount was due to an unrecognized franchise right with a remaining life of 4 years as at 1 December 2023. No entries have been recorded in respect of this franchise right. On 1 December 2021, Joey acquired 30% ordinary shares of Maggie for a cash consideration of $600 million. Joey treated Maggie as an associate and has equity accounted for Maggie up to 1 December 2023, and share of post-acquisition retained earnings and other components of equity was $90 million and $10 million respectively. Joey's investment in Maggie as at 1 December 2023 is still included in the consolidated financial statement of financial position. At 1 December 2023, the fair value of 30% equity interest in Maggie held by Joey was $705 million. Right? On 1 December 2023, Joey acquired a further 40% of ordinary shares of Maggie for a cash consideration of $975 and gained control of the company. At 1 December 2023, the fair value of Maggie's identifiable net assets was $2250 million. The fair value of non-controlling interest was assessed as $620 million a bargain purchase of 655, which is 975 plus 620 minus net assets, has been recorded in the profit or loss. Additionally, buildings with a carrying amount of 200 million had been included in the fair valuation of Maggie at 1 December 2023. The buildings have a remaining useful life of 20 years at 1 December 2023. However, Joey had commissioned an independent valuation of the buildings of Maggie, which was not complete at 1 December 2023, and therefore not considered in the fair value of the identifiable net assets at acquisition date. The valuations were received on 1 April 2024 and resulted in a decrease of 40 million in the fair value of PPE at the date of acquisition. The fair value decrease, which does not affect the fair value of NCI at acquisition, has not been entered in the financial statements of Maggie or the draft consolidated statements. Buildings are depreciated on a straight line basis. Joey is looking to expand into publishing, and he has entered into an arrangement with Content Publishing, a public limited company, on 1 December 2023. CP will provide content for the range of books and online publications. A CP is entitled to a royalty calculated as 10% of sales and 30% of gross profit of the publications. Joey has a sole responsibility for all printing, binding, and platform maintenance of the online website. The agreement states that key strategic sales and marketing decisions must be agreed jointly. Joey selects the content to be covered in the publications, but CP has the right of veto over this content. However, on 1 June 2024, Joey and CP decided to set up a legal entity, JCP, with equal shares and voting rights. CP continues to contribute content into JCP but does not receive royalties. Joey continues the printing, binding, and platform maintenance. The sales and cost of sales in the period were 5 million and 2 million respectively. The whole of sales proceeds and the costs were recorded in Joey's financial statement, with no accounting entries being made for JCP or amounts due to CP. Joey currently funds the operations, assume that sales and costs accrue evenly throughout the year, and all the transactions relating to JCP have been in cash. Required. Explain with suitable workings how to correct the errors that have arisen when accounting for the acquisition of Houghton. Show the adjusting entries required to correct the consolidated statement of financial position. So you can see this is this is a typical SBR question. I'm sure some of you came from college. When you are doing degrees, you are used to questions which say, prepare consolidated statement of financial position. Prepare consolidated. That's what you know as groups. But SBR now, it's a different style of examining questions altogether. What SBR entails is, you'll be told that directors or accountant has done this, and there are errors in there. So you need to to explain those errors and then effect journal entries to correct. No wonder why they are saying explain errors made when accounting for the acquisition of Houghton. So that's when they say explain, You are telling the examiner that what the standard says against what these guys have done, so that you can point out the mistakes which the accountant has made, and your correction of those mistakes becomes an informed position. Right. So, coming back to the question, what are the errors that were made? The first one is like this. When they calculated goodwill, they considered carrying amount of net assets. They didn't consider fair value here. So that's error number one. So we need to make sure that we calculate goodwill properly and correct these errors. Error number two, they are saying shortly after acquisition, the accountant realized the following. In other words, this here was not even accounted for. A deferred cash consideration of 50 million arising on acquisition of Houghton had not been recorded. Remember, when you acquire a subsidiary and there is a deferred consideration, in other words, payment that will be made at a future date, the present value of deferred consideration must again be part of consideration transferred. So there's need for us to calculate present value of this 50 million and include it in the purchase consideration. So they just considered cash payment of 750 and ignored deferred consideration at present value. So that's mistake number two. Another mistake, I just want to identify mistakes for you. Another mistake is you are told that the fair value of Houghton's identifiable net assets was 980. So the carrying amount was 960. The fair value was 980. So they are saying the difference between 980 and the 960, which they are referring to as excess of fair value over net assets. This phrase here. The difference between 980 and 960, which is the 20, it is due to unrecognized franchise right with a remaining life of 4 years. So what it means is the accountant ignored again the franchise right with a remaining life of 4 years. So I'm sure we have now managed to get the errors. Now the question says explain. So remember, this is our notes. We are actually writing the notes. So I will be dictating whilst you are writing. It works that way. It works that way. When I need to perform some workings, I will then come to the write this. IFRS 3 business combination. IFRS 3 business combination. IFRS 3 business combination states that goodwill be calculated as the difference between must be calculated as the difference between the sum of the difference between the sum of consideration transferred, and NCI consideration transferred and NCI less the fair value of subsidiaries identifiable net assets. Less the fair value of subsidiaries identifiable net assets. Less the fair value of subsidiaries identifiable net assets. The fair value of subsidiaries identifiable net assets. Also, deferred consideration must be recognized at its present value. Deferred consideration must be recognized at its present value. Must be recognized at its present value. At acquisition date. Its acquisition date. Full stop.
Sorry, sir, may you repeat the statement again?
Okay, I said also, deferred consideration must be recognized at its present value at acquisition date. Must be recognized at its present value at acquisition date. Must be recognized at its present value at acquisition date. Right. Okay, so I can see here we have got others who have joined us today, like Rumbi. So Rumbi, what will happen is I will give you the first video. Remember, this is now illustrations. There's a video where I explained everything that we are discussing now. So what you then have to do is, for this particular lecture, you are doing the listening. But after this lecture, I'm going to send you the previous video. If you play that video with this one now, you play that one first because I explained everything in that video. This lecture is about illustrations of those particular notes that we had in previous lecture. So you may wonder and say, why is it we are starting with illustration? It's because we have already done the notes. I will send you the video. You play that video first and then replay this one to catch up.
Okay, sir.
Right. Okay. Then so write this. Applying the above guidelines, comma, applying the above guidelines, comma, the following errors were made. The following errors were made. Right. So this is about acquisition of Halti. Acquisition of Halti. So these are the errors that was made. So the first one is omission of deferred consideration. Omission of deferred consideration. That's error number one. Omission 1, omission of deferred consideration, Remember, this is at its present value, right? So you are saying 50 million times, they are saying cost of capital is 10%, or the discount rate is 10%. So it's 50 million times 1,1 to the power of, you check, we we acquired on 1 December 20x3, but this one was to be paid 30 November 20x5, meaning about 2 years later, because there's 20x4 and then 20x5. So PV is to the power 2 to the power minus 2, right? To the power of minus 2. What do you get? What do we get? 50 million times 1,1 to the power of minus 2. Right, 41,32. 41,32 million. So 41,32 was deferred consideration. It was not taken into account. Again, another error was fair value adjustment on franchise rights 2. Fair value adjustment. Value adjustment on franchise right. What we mean by this? We are told here that net assets were 960, but their fair value was 980. Meaning, when you acquire, you don't say less net carrying amount, rather you say less fair value. So there was need for a fair value adjustment of franchise right here, which is 980 minus 960. So you get 20 million. So these are the two main errors that we have. Now the question then proceeded and say, show the adjusting entries to correct these errors and to correct consolidated statement of financial position. So for you to understand this, let me open the handout that we had last lecture on groups. This one is the handout that I'm talking about. This is the handout I'm talking about. Make sure you have it again. Make sure you have it. Let me send it here also. Allow me to send it here. For those who don't have it, let me send it. This is all you need on groups. Pre-read groups. Okay. So the deal is, in this particular handout, we discussed how to calculate goodwill. Let me open the guidelines that we were having one. Why I'm opening this, I want you to see that this is where the line of thinking is coming from. Displaying on your screen there, it's a template on how goodwill is calculated. You say consideration transferred plus fair value of NCI less fair value of subsidiaries net assets. Now, the question then says, show the adjusting entries required to correct these errors that were made. So for you to know, to see how the error will be corrected, you need to determine what is the effect of that error on this particular working here. You need to determine the effect of the error. It's like here on fair value adjustments, we omitted, we are told here that we omitted 20. So what it means is, if we put 20 here under fair value adjustment for the franchise right, if we put 20, what will happen to goodwill? You will notice that goodwill will decrease. If you put 20 here, because they omitted 20. So if you come here and put 20 here, your goodwill here will decrease by that 20. Another thing is, deferred consideration was omitted from consideration from the top line here. We omitted deferred consideration from this top line here. So the question is, if you put 41,32 here to increase this figure by 41,32, what will happen to goodwill? So you'll be asking yourself these questions. For you to know how to correct this, this is what you'll be asking yourself. To say the accountant omitted deferred consideration in this line of consideration transferred. The accountant omitted deferred consideration. What effect does it have on goodwill if we put it back? You'd notice that it will increase goodwill. So what you then have to do is, if they say accounting entries, they are saying journal entries. So what you then have to do is, you say journal entries to correct the errors. Journal entries to correct the errors. Journal entries to correct the errors. Right. Then we start with 1. Deferred consideration. Deferred consideration was omitted. So you ask yourself, if we here in the top line we omitted 41,32. So my goodwill is going to increase if I put it there. So you say debit goodwill. Debit goodwill. Debit goodwill. You debit goodwill by 41,32. Remember, these are millions. These are millions. And then you credit liabilities. Credit liabilities, because deferred consideration, it's a liability. It's the amount that you will pay. Liabilities, 41,32. 32. So that is the first journal entry there. Then the second one, in the like manner, it's like this. We omitted this 20 million on franchise right. So when you want to see how to correct it, don't claim, don't put yourself under unnecessary pressure. No. All you have to do is to come back to your goodwill template. You omitted franchise rights on fair value adjustments here. If you put 20, what will happen to my goodwill? It will decrease. So I then say debit franchise right, because it's an asset. Franchise right. Franchise right. 20 20, and then credit goodwill. Credit goodwill. Credit goodwill. Credit goodwill with that amount, 20. Now, you can now have what we refer to as year-end adjustments. Or let me not bother myself with terminology there. Let me just proceed. We are told that the franchise right had a remaining useful life of 4 years. So if we need to depreciate it over 4 years. No wonder why the examiner is saying here, the examiner is saying, show the entries required in the consolidated statement of financial position here. In other words, we also need year-end adjustments, meaning those entries in the financial statements. So you need to, in other words, franchise rights at the year end, it's no longer at 20 because it had a life of 4 years. So it is depreciated by the first year, which is 20/4. So what you do is you say debit consolidated retained earnings, consolidated retained earnings. You know, that's your SBR. SBR, this is how we don't even ask you to say prepare. No. We don't even ask you such a question. We give you information prepared already, but you need to figure out in what way is this an error going to affect the accounts. So consolidated retained earnings. Now notice something on this one. We acquired Joey what percentage? I mean, how we acquired it, what percentage? 80%. So it means on this amortization of franchise right, our share is 80%. The other share goes to NCI. So you say 80% times 20/5. 80% times 20/5. What do you get? 20/4. Sorry. This is it. It has a life of 4 years. So guys, 80% of 5. Okay, so you get 4. And then you say debit NCI 20% times 20/4. Get 1. And then you say credit. Also, this one was debit NCI again. This one was debit. And then you credit franchise right.
Sorry, sir.
Yes.
May you explain the journal that we're doing right now? So the Sarira from retained earnings per journal.
Okay, because I'm sure you are okay with the first 2 journals, right?
Yes.
But the question now is saying, show also the entries required in the consolidated statement of financial position. Meaning, at acquisition, you recognize the franchise right, but in the balance sheet, is it still at 20? You get
No.
that? So we need, these are the entries we are now doing to acknowledge that it's no longer at 20 because it is amortized for a year, for the first year. Is that okay?
Yes.
Good.
And the 80% is it because we are using fair value?
80% is because this depreciation is in the accounts of a subsidiary. So a subsidiary's profits are to be reduced by 5. But of that, we own it 80%, meaning we are profit for the consolidated will reduce by 4. The other goes to NCI.
Okay.
All right. So, okay. So narration for this is amortization of franchise right. Amortization of franchise right. It's amortization of franchise right. So there you go. So what else in your opinion is required? There is a deferred consideration. Do you still remember what I said when there is deferred consideration as the time passes? Can someone who still remembers tell me what I said we do?
We are supposed to unwind for discount.
We are supposed to unwind the discount. Good. So here there's need to unwind the discount. So you say unwinding the discount. Unwinding the discount. Unwinding the discount on deferred consideration. And unwinding the discount on deferred consideration. So, you know what Ivy is saying when she's saying unwinding the discount? This payment, you will pay it after 2 years. It will be 50 million. But today is 41,32. So it is going to increase with interest. You recognize its present value, but it is going to increase with interest. So that interest is what we are referring to as unwinding. So you say debit, consolidated retained earnings. This time, this one, you don't take 80% because this is in our books as a parent. It is us who are going to pay. It has nothing to do with subsidiary. So you just say 10% of 41,32. 10% times 41,32. We close there. So it becomes 4,13. 4,13. And then we then credit liabilities. $4,113. Right. You are done. Once you get there, you are done. So that's what the examiner wants. Any question?
Okay.
All right. always feel free to ask. You are always free to ask. All right. Continuing. Let me proceed. Let me read the question. Explain with suitable workings how to correct the errors that have arisen when accounting for the acquisition of Maggie. Show the adjusting entries required to correct the consolidated statement of financial position. Now, this is no longer about how it's now about Maggie. So yes, so Maggie, we are starting where? We are starting here. On 1 December 2021, Joey acquired 30% of ordinary shares of Maggie for a cash consideration of 600 million. Joey treated Maggie as an associate and he has equity accounted for Maggie up to 1 December 2023. And the share of post-acquisition retained earnings and other components of equity was 90 million and 10 million respectively. Joey's investment in Maggie as at 1 December 2023 is still included in the draft statement of financial position. At 1 December 2023, the fair value of 30% equity interest in Maggie held by Joey was 705. On 1 December 2023, Joey acquired a further 40% of ordinary shares of Maggie for a cash consideration of 975 and gained control of Maggie. At 1 December 2023, the fair value of Maggie's identifiable net assets was 2250. The fair value of controlling interest was assessed to be 620. A gain on bargain purchase, meaning negative goodwill. So notice how they calculated goodwill. No wonder why they have a negative goodwill. Here's how they calculated it. They said Joey initially had 30%, and then after that it increased by buying additional 40%. So what it means is it's now a 70% owned subsidiary. 30% we had initially plus 40% to make it 70. So NCI is now 30%. So this particular transaction, we said it is like a swap and top transaction. And when you are calculating goodwill under the circumstances, you calculate goodwill like this. Notice I'm scrolling down because I want to show you that I am not thinking outside the box. I'm just right here. These are our notes. It was an associate and now it becomes a subsidiary. Here is how you calculate goodwill. Here. This is how goodwill is calculated. I said it is actually like a swap and top transaction. You had, let's say you had a 323 car, and now you have got a Fortuner. A Fortuner being now the subsidiary. So if you get to a car sale and ask those guys to say, I have my 323, I want a Fortuner, but let us have a swap and top transaction. You know, the car sale guys, they don't ask you how much did you pay for the 323. No. What they do is they say what the fair value of 323 is so much. And then suppose they say fair value is 4,000 and a Fortuner is going for 48,000. So if you get to car sales with your 323 for a swap and top transaction, the car sale guys, what they simply do is they say fair value of your 323 is 4,000. Now a Fortuna is going for 48. Can you pay additional 44? It is of no interest to them to know how much did you pay for the 323. No. So you get that. Also in your books, the 323 is effectively disposed. So you need to calculate gain or loss on disposal of the 323, because effectively speaking, it has been disposed. So no wonder why I said you calculate goodwill like this. You say consideration transferred, like in this case, Fortuna is 48 and you pay 44. Add fair value of previously held interest. That's the fair value of the 323. So this is how you calculate goodwill. Amount you pay, it's a swap and top transaction. 44,000 that you pay plus the fair value of the 323. But also in your books, you need to de-recognize the 323, because effectively speaking, you have sold it. I'm sure that one explains it. Now, so here, when they calculated goodwill, they just considered payment we made, like the 44, and they ignored fair value of the 323. So 705 is the fair value of the 323. It was ignored in goodwill calculation. Yet they were supposed to say 975, which is the amount you topped up, plus fair value of the previously held interest. That's your 323. And you then say plus NCI less net assets. So you can see, no wonder why I'm saying I discussed all this in the previous lecture. So those who have joined us, once you get to the previous videos, everything I'm saying here makes sense because I explained it. So you play that video first and replay this one. This applies also even to those who were in that lecture, because perhaps you might have forgotten. Right. Remember also what I said. Does anyone still remember what I said about measurement period? Measurement period. You can unmute and talk to yourself. Okay. All right. You know, I said IFRS 3 sets a measurement period of 12 months. You know, actually what happened is when you acquire a company, you don't have enough information. There are certain things that you may need time to get the actual picture. Take, for example, a situation where you want to value buildings. By the time you acquire, you might be in a position where you are yet to get the actual valuation. So what the standard says is that it gives you, the acquirer, 12 months to evaluate the assumptions that were used in coming up with fair values. If you get new information within the 12-month period from the date of acquisition, if any new information is obtained during this period, you can revisit your goodwill and retrospectively adjust it. Let me repeat. IFRS 3 sets a measurement period of a maximum of 12 months. Within this period, the acquirer can assess how the reasonability of the assumptions used in coming up with fair values at acquisition date. You get that? If new information is obtained during this particular period, the acquirer can retrospectively adjust the goodwill estimated at acquisition. This is what I'm talking here. IFRS 3 sets a measurement period. So there you go. The highlighted information there is what I'm referring to. So in this particular question, we are told that when they came up with a fair value of 2250 million, they commissioned an independent person to value buildings. And these buildings, they have a carrying amount of 200. They are already included in 2250. But Joey found someone to get its fair value. But by the time we acquired, which is 1 December, that valuation was not complete. Because valuation was not complete, it was then received on 1 April 2024, meaning it is still within the 12 months measurement period. And when the valuations were received, they told us that this 200 million needs to be reduced by 40 million. Needs to be reduced by 40 million. That's what they told us. And they had still a life of 20 years and are being depreciated on a straight line basis. All right. So all this is an error which they made, because 200 million was not reduced by 40 million. So they made an error in calculating goodwill. They also made an error in failing to adjust that 40 million. Right. So let me dictate whilst you are doing the writing. Write this. IFRS 3 business combination, that's the standard we are talking about. IFRS 3 business combination provides that whenever a subsidiary is acquired in stages, comma, the fair value of previously held interest, forms part of consideration transferred. The fair value of previously held interest forms part of consideration transferred. Forms part of consideration transferred. Write this. The acquirer also calculates gain or loss on derecognition. The acquirer also calculates the gain or loss on derecognition. The acquirer also calculates the gain or loss on derecognition of the previously held interest. Gain or loss on derecognition of the previously held interest. on derecognition of previously held interest. All right. Right. The standard also sets a measurement period of up to 12 months. The standard also sets a measurement period of up to 12 months. Of up to 12 months from the acquisition date. Of up to 12 months from the acquisition date. Within this period, comma, within this period, comma, the acquirer can assess the reasonability of the assumptions. Reasonability of the assumptions used to determine the fair values of net assets at acquisition. Used to determine the fair values of net assets at acquisition. Fair values of net assets at acquisition. Right. If any new information is obtained during this period, comma, the acquirer can retrospectively adjust goodwill estimated at acquisition. The acquirer can retrospectively adjust goodwill estimated at acquisition date. Right. Okay. So, applying the above guidelines, comma, the accountant made the following errors. The accountant made the following errors. The accountant made the following errors. All right. So that's how you will be answering these questions. So the error number 1 is fair value of previously held interest. Fair value of previously held interest. Value of previously held interest of 705 million. 705 million was omitted in goodwill calculation. Goodwill calculation was omitted in goodwill calculation. So this was the first error. Right? Gain or loss on derecognition of the associate was not calculated. Gain or loss on derecognition of the associate. Derecognition of the associate was not calculated. Not calculated. Another error was measurement period adjustment on buildings. Measurement period adjustment. Measurement period adjustment on buildings. Buildings. Right? Was not affected. Was not affected. Sorry guys, today flu. Today it's actually better. It's actually better.
And then I'm not test question.
All right, the giant. The giant. All right, so there you go. So now notice journal entries to correct these errors. This is where you need to know. You don't think outside the box on this one. No. What happened was you come to your notes. By the time you enter the exam, all these should be on the back of the top of your mind. This is the goodwill when you acquire a subsidiary in stages. This is how you calculate goodwill. So, fair value of previously held interest. This line here was omitted. Was omitted, and we need to calculate it. We need to include it. So what will be the effect on goodwill? This is what you'll be asking yourself. You don't need to worry much. Examiner knows that you know that goodwill is calculated like this. Here, the question is not saying calculate goodwill. You may run the risk of saying of calculating goodwill. Yet the question is not saying that at all. It's saying explain with suitable workings how to correct the errors. Now, whenever you're explaining a accounting issue, you cite the standard. You cite the standard. You don't explain from your mind. Now, they didn't put 705 here. So what you need to know is we need to if we put 705, it means goodwill is going to increase by 705. That's another thing. Another thing is on measurement period adjustments. Here they are saying when the valuations came, they told us that buildings which were included in net assets, they need to be reduced by 40. So this figure here needs to be reduced by 40 million. So what will happen to your goodwill? Goodwill will increase by 40 million. If you reduce this figure here by 40, goodwill will increase by 40. Knowledge of this is important because it forms the basis of journal entries. you need to know which account is affected, which one is not. So the accounting entries are like this. Debit, we start by retained earnings. Debit retained earnings. We are eliminating bargain purchase. Eliminating bargain purchase. Eliminating the bargain purchase. We are told that the bargain purchase was calculated as 655 million. So we eliminate 655. Why are we saying debited? Because they told us that it was recorded in profit or loss. So it's in retained earnings. That's what they mean by this. So we need to take it out. And then credit goodwill. Credit goodwill. Right? 655. That's the narration is eliminating bargain purchase. That's what we are eliminating. Then what about the fair value of previously held interest, which was omitted here? This one will increase goodwill. This one will actually increase goodwill. So you say goodwill. Okay, sorry, debit goodwill. Goodwill. So you debit goodwill with 705. 705. Remember, this is a swap and top transaction. This is a swap and top transaction. We shall, you know, it's like you go to the car sale with your 323 and they say it's 4,000. So this is your car sale, your 323. They say it's 705. But I said, effectively speaking, you have sold your 323. So what you then do is you say credit, sold it. It was an associate, so you credit investment in associate. Investment in associate. What is the carrying amount of this investment in associate? Everything is here. Notice in the notes, if you want to see the investment in associate, you say cost plus share of post-acquisition reserves less any impairment. Here you go. That will be the carrying amount. So in this particular question, cost of the associate was 600. Share of post-acquisition reserves was 90 plus 10. So you are given here. So you say open bracket 600 plus 90 plus 10. So that's 700. So you can see that the journal is not balancing. So because the 323 in your books is 700, but the car sale guys, they say it's 705. So you have made a gain of 5. No wonder why we say you calculate gain or loss on derecognition of an associate. So you then say credit retained earnings. Credit retained earnings. Right? So by retained earnings, this will become gain on derecognition. On derecognition. Recognition of associate. That's 5. All right. So that one is cool. That's what you'll be doing. And then you can now proceed and say, notice how I'm putting my journals. This is how I want you also in the exam to put your journals this way. Now there is measurement period. We are told that in this fair value of net assets of 2250, there's a building with a carrying amount of 200, and we commissioned independent valuation of it. By the time we got it, they told us the value must be reduced by 40. So if you want to know the journal entry for this, you come here. You need to have this with you. Fair value is 2250. They are saying you need to reduce this figure here by 40. So goodwill will increase by 40. Goodwill will increase by 40. And then buildings will decrease by 40. So you simply say debit goodwill, debit goodwill, debit goodwill 40. Then credit buildings. Are you seeing that this is SBR? Typical SBR. We don't ask you to prepare or to calculate goodwill. We just calculate it for you, but we do it wrongly. And then we ask you to explain errors. You know, when you are explaining, that's where we know whether you know your stuff or not. Right. So this is measurement period of 40. Now, now you need to understand something. These buildings, they are saying they had a life of 20 years. So what it means is, because we have reduced them by 40, there was excess depreciation. They were being depreciated at 200 instead of 160. So there is excess depreciation on buildings. Excess depreciation on buildings. Excess depreciation on buildings. So what you simply do is you debit, because we were over depreciating it because the value was now reduced. So you debit buildings. Debit buildings by 40 million over 2. 40 million over 20. You get 2. Then you credit consolidated retained earnings, consolidated retained earnings, it will be 70%. 70% times 2. Our retained earnings, we take 70% by 2, 1,4, and NCI takes the balance. Credit NCI. And 30%. You get 0.6. Right. So you're done. You're done. That's all that was required on this question. Now, continuing. Discuss with suitable workings how the agreement with CP should be accounted for in the consolidated financial statements. Right. Now, let us read the agreement with CP. They are saying, starting from here, they are saying Joey is looking to expand into publishing and entered into an agreement arrangement with Content Publishing, a public limited company, on 1 December 2023. CP will provide content for a range of books and online publications. CP is entitled to a royalty calculated as 10% of sales and 30% of gross profit of the publications. Joey has sole responsibility for all printing, binding, and platform maintenance of the online website. The agreement states that key strategic sales and marketing decisions must be agreed jointly. Joey selects the content to be covered in the publications, but CP has the right of veto over this content. However, on 1 June 2024, Joey and CP decided to set up a separate legal entity, JCP, with equal shares and voting rights. CP continues to contribute content into JCP, but does not receive royalties. Joey continues the printing, binding, and platform maintenance. The sales and cost of sales in the period were 5 million and 2 million respectively. The whole of sales proceeds and the cost of sales were recorded in Joey's financial statements, with no accounting entries being made for JCP or amounts due to CP. Joey currently funds the operations. Assume that sales and cost of sales costs accrue evenly throughout the year, and that all transactions relating to JCP have been for cash. Right. Now, these are known as joint arrangements. Joint arrangements, normally they take two forms. There is what is called joint operation and a joint venture. Do you guys still remember the distinction between the two? Anyone who still remembers the difference between joint operation and a joint venture? Right? Joint operation and a joint venture. So what is happening here is, oh, sorry, Mishi. So Mishi, you need to hang in there. Don't exit the chat. Otherwise the lesson will cut, because I notice you are the only one left. So here's the deal. Here's the deal on this one. In a joint operation, parties do not form a separate legal entity. That's a joint operation. In a joint venture, it involves actually forming a separate legal entity. And the company that you form, if you and I want to enter into a joint venture, we form a separate legal entity. And then what then happens is we co-own it and co-run it. Decisions are by mutual consent. One can veto the decisions of the other. You get it? So clearly, from 1 December 2023, it was a joint operation because there was no separate legal entity. But from 1 June, when we formed a separate legal entity, it then became a joint venture. So for a joint operation, accounting is different with the joint venture. So just a second, I'll be back. Okay, I'm back. So, what is it that I was saying? I was saying from 1 June, it was now a joint venture because we formed a separate legal entity. So when you are writing this, all you have to do is you say the circumstances presented. That's C. Circumstances presented provides evidence of a joint operation. Provide evidence of a joint operation. Evidence of a joint operation from 1 December 2023. From 1 December 2023 to 1 June 2024. To 1 June 2024. That's 6 months. In brackets, you say 6 months. Right? We'll proceed and say after 1 June 2024, comma, The arrangement became a joint venture. The arrangement became a joint venture due to the formation of a separate legal entity. Due to the formation of a separate legal entity. Due to the formation of a separate legal entity. So it was now a joint venture. Like this. So they are saying sales were 2 million and cost of sales were. So they are saying Joey recorded everything in its books. Yet it has a partner which is called CP. But Joey recorded everything in its books, ignoring CP completely. So what we then have to do is, we are saying, okay, what we are saying here is from 1 December X3, 1 December X3 to 31 May X4, right, from 1 December X3 to 31 May X4. What happened here was, it was a joint operation. Joint operation. It was not a joint venture. Why? Because there was no separate legal entity for that. So you say sales 5 million times 6/12, you get 2,5, and then costs again is 2 million times 6/12, right? You get 1, and then you say equals this minus this. So this becomes your profit. This is your profit, gross profit. Right. Now, for this part of the arrangement, we are told that CP was to get 10% of sales and 30% of gross profit. So you say due to CP amounts due to CP, because CP was, they are saying Joey recorded everything as if it. So the amount due to CP is 10% of sales. 10% times 2,5, right? 10% of sales plus 30% of gross profit plus 30% times 1,5. Right? So it becomes 0,25 plus 0,45. So it becomes
Hello, guys. Hello.
Hello, we can hear you.
Oh, Seva Chico.
Eva,
We want to do illustrations. All right, let me also share my screen. Now, the question is, we had done all other questions. I'm sure you can play yesterday's video. Now, we were on this question, which says, discuss with suitable workings, which is question number 3. Discuss with suitable workings how the agreement with CP should have been accounted for in the consolidated financial statements. We have done part of it yesterday, but we need to finish it up. So we are told by the examiner somewhere in the notes, in the question there, where it's highlighted, they are saying, Joe is looking to expand into publishing and he has entered into an arrangement with content publishing. Okay, let me move this. He has entered into an arrangement with content publishing, a public limited company, on 1 December 2023. CP will provide content for a range of books and online publication. CP is entitled to a royalty of 10% of sales and 30% of gross profit of the publications. Joey has sole responsibility for all printing, binding, and platform maintenance of the online website. The agreement states that key strategic and marketing decisions must be agreed jointly. Joey selects content to be covered in the publications, but CP has the right of veto over this content. Then, however, on 1 June 2024, Joey and CP decided to set up a legal entity, JCP, with equal shares and voting rights. Okay, am I recording the lecture? Okay, great. With equal shares and voting rights. CP continues to contribute content into JCP, but does not receive royalties. Joey continues printing, binding, and platform maintenance. The sales and costs of sales were the wall of sales. The sales and cost of sales in the period were 5 million and 2 million. The wall of sales and sales proceeds and cost of sales were recorded in Joey's financial statements, with no accounting entry being made for JCP or the amounts due to CP. Joey currently funds the operations. Assume that the sales and costs accrue evenly throughout the year, and that all transactions relating to JCP have been in cash. Now, you can see, I explained this yesterday. You can see here that from 1 June, from 1 December to 31 May, this was a joint operation. It was not a joint venture because there was no separate legal entity. So we did that part yesterday. Just play the video. We were going now on from 1 June 2024 to 30 November 2024. In this case, it's now a joint operation. Reason being, the parties have formed a separate legal entity, and it is being run by mutual consent, because still they have they have equal voting rights. When they say equal voting rights, we say mutual consent. Decisions must be made based on mutual consent. Right. So, all right, sorry, Stabile, allow me to mute you. Okay. Right. So we are continuing from where we were. We are now saying from 1 June 20x4 to 30 November 20x4. Now this one was a joint venture. This was a joint venture. So you have to take to the examiner. Why is it you are saying this circumstances presented meet the criteria for a joint venture? So write this. A joint venture arose in this case due to the formation of separate legal entity. A joint venture arose in this case due to the formation of separate legal entity with parties have equal voting rights. With parties have equal voting rights. Therefore, decisions are to be made with mutual consent of the parties. Decisions are to be made with mutual consent of the parties. Right? A joint venture is equity accounted. A joint venture is equity accounted. A joint venture is equity accounted. Right? In Joey's books. So what you do is you say sales over 12 was 2.5 million, 2.5 million, and then cost of sales, cost of sales, it's again for 6 months, you get 1 million, right? Then you say gross profit, this minus this, right? Now that these parties now have mutual consent, what it means is what Joey must do, Joey has recorded everything, even the amounts which are due to CP. Joey has recorded all those monies as if they belong to itself. So what need to be done is, it means retained earnings for Joey is overstated by 1.5. So what you then have to do is accounting entries. Joey's books. right? So what you do, remember, it's now a joint venture. Joint venture, you don't take sales and add them to your sales. You don't take cost of sales and add them to your cost of sales. No. A joint venture is equity accounted, meaning you only take your share of profit. In this case, the full 1,5 must first be eliminated. So you say debit, consolidated retained earnings, consolidated retained earnings. We eliminate the full amount because it's now a joint venture. Then what you then do is these retained earnings, they relate to another company altogether, which is called JCP. So what you then have to do is you then have to credit JCP. It is this company which owns this profit, not Joey. Now, what Joey should then do is to take its share from the joint venture. So you then say share of profit from the joint venture. Share of profit from the joint venture. Share of profit from the joint venture. So this one is an easy stuff. All you do, you say investment in joint venture, it's an asset. Okay, so you debit. Investment in joint venture. Investment in joint venture. Right? So you take your share, which is 0.75, half of 1.5, it's 0.75. And then you credit consolidated retained earnings with your share. Consolidated retained earnings, 0.75. Okay, so that's all that was required on that question. So you play the last part of yesterday's video and join with this, because the first 6 months, it was a joint operation. The other 6 months, it was a joint venture. You get that? Okay. Now, let us proceed with our questions. Right? Today I had to sacrifice the SEMA students.
Sir,
So, yes.
sorry, can you bring the last journal back up again? I hadn't finished copying.
All right. There you go. Right? And you know that your exam is computer-based. So this is how you'll be answering it. It's not a paper-based exam. So even though you're writing in the notebook, but as you can see, we are typing it here on the laptop. So you can actually see that it is actually doable on the Excel. Right.
I'm done. Okay, thank you.
Then there is Question number 2. Kuchen Group. I don't know how to pronounce it. It says acquisition of house. On 1 June 2006, Kuchen acquired 70% of the equity interests of house. The purchase consideration comprises of 20 million shares of $1 per value. So it was a share exchange. And a further 5 million shares if house's net profit after tax was at least 4 million. So because there is this word here, if, it means this is a conditional or contingent consideration. Right? All these are past papers. For the year ending on that date. So in other words, we gave them 20 million shares and we promised them to give them additional 5 if their profit after tax was at least 4 million. The market price of Kuchen's shares on 1 June 2006 was $2 per share, and that of house was $4.20 per share. In accounting for the acquisition of house, the finance director did not take into account. So that's an error there. So these are typical SBR questions. The finance director did not take into account non-controlling interest in the goodwill calculation. He determined that a bargain purchase of 8 million arose on acquisition, being the purchase price of 40 million. 40 is like 20 million shares times 2. That's where 40 is coming from. Less identifiable fair value of identifiable net assets of 48. So they just said 40 minus 48. They did not account for NCI in goodwill calculation. After the directors of Kuchen discovered the error, they decided to measure non-controlling interests at fair value at the date of acquisition. The fair value of NCI in the house was based on the quoted market price at acquisition. In other words, if we are told that market value of shares of a house is $4.20, this is the quoted price. So when they want to value NCI, they are going to use that price. That's what they are telling us here. House had issued share capital of $1 each, totaling to 13 million. So this information you are given because NCI is 30% because we acquired 70%. So there you go. So I don't want to open as much questions as possible, one at a time. Let us go to the questions. Otherwise, your mind will be stuffed. One at a time, and then we proceed. Explain to the directors of Kuchen, with suitable workings, how goodwill should have been calculated on the acquisition of a house and of March, showing adjustments which need to be made in the consolidated financial statements to correct any errors made by the finance director. So far they want house and March, but for now let us focus with house. So they just want you to tell us how goodwill should have been calculated. So you need to recalculate it. That's what it means. and explain it first. So this is your handout, which I was using yesterday, and I said whenever this handout must be off the top of your head, off the top of your head. So let me get there. Notice this is how goodwill is calculated. What we have here is how goodwill should be calculated. So they are saying explain that. So let us explain. Write this. IFRS 3 business combination. Yeah, you have written acquisition of house. IFRS 3 business combination states that goodwill is calculated as the difference between the sum of consideration transferred plus the fair value of NCI less the fair value of subsidiaries identifiable net assets. Less the fair value of subsidiaries identifiable net assets. Right? Okay. So write this. A contingent consideration in the form of shares. A contingent consideration in the form of shares must also form part of consideration transferred. At fair value. Must also form part of consideration transferred at fair value. Right? Such consideration is recognized in other components of equity. And is not subsequently remeasured. So you see, that's what you need to do. Then applying the above guidelines, goodwill on acquisition of a house should have been calculated as follows. Goodwill on acquisition of a house should have been calculated as follows. Right? So there you go. It's a matter of, notice the template for my goodwill working is there here. I'm going to use this to calculate goodwill. So I need how many columns? 2 columns perhaps, or even 1 column. Millions. You say consideration transferred. Consideration transferred. So the consideration transferred was in 2 parts. There was share consideration. Share consideration, which is 20 million shares times 2. Get 40. So 40 here. And then you say contingent consideration. Contingent means conditional consideration. Now, how do we calculate conditional consideration? You come to the question. It's saying a further 5 million if that's condition now. If profits are at least 4 million. Now they are saying it was felt that there is 20% chance of the profit target being met. So what it means is you need to say 5 million times $2 times 20% equals 5 times 2 times 0.2, you get 2. And then you say add fair value of NCI, value of NCI. Now it's a matter of just coming to the question. They are saying they are going to use market price of house, which is $4.20, and NCI is 30% of 13 million shares. So 30% of 13 million times $4.20. 30% times 13 million times $4.20. So there you go. You say equals 0.3 times 13 times 4,2. So that's your NCI. So you can add these figures up like this. You get 58,38, and then you say less fair value of net assets. Net assets. Now fair value of net assets is there. Here they are saying it's 48. So you come here and say minus 48. And then you have goodwill. That's your goodwill. 10,38. Goodwill. Now, what are the accounting entries to correct the errors? That's typical SBR questions. Accounting entries correct the errors. what happens here, you would notice that contingent they had recognized a bargain purchase, meaning negative goodwill of 8. So what you do is you first eliminate bargain purchase, debit retained earnings. Remember, bargain purchase means negative goodwill, so it is recorded in retained earnings. So we need to eliminate it. See that? Retained earnings, and here we are eliminating bargain purchase. Eliminating bargain purchase. Right? So there you go. You put 8 million, and then this 2 million was not recorded. Notice 2 million has increased the goodwill. So we debit goodwill again. Debit goodwill. Goodwill with contingent consideration. Contingent consideration. You put 2. Right? NCI was not recorded. So again, we debit goodwill because NCI has increased goodwill. Debit goodwill with 16,38. Let's see the credit entries now. The credit entries are like this. The credit entries are now like this. We are going to credit other components of equity with contingent consideration. Contingent consideration. Consideration 2. We also need to credit NCI.
Understand?
Yes.
Why are we debiting goodwill with 16.38? Are we not supposed to debit it with 10.38? That's what we got for goodwill. I don't know about others.
Okay, let me check. Let me just put the last entry. Credit NCI. NCI, right? 16,38. 16,38. Right? So, okay. So if we debit goodwill with 10,38, you are right. You are right. The first part here, we need to debit goodwill with 10, let me see, will the journal balance 10,
I think there's an error.
will it balance if you put
no, the retained earnings were 8. Are they not?
Yes, they were 8. 8. And then we credit if we put 10,38, it will be 26.
The journal where we are debiting goodwill with 2.
All right. Because you know what? These are the accounting entries necessary. So let us now, for our journal to balance, let us ignore everything and just focus on what was omitted for now. If you say 16,38 plus 2, you get 18. If you say 10,38 plus 8, you get 18. Yes. So let us focus. So the first one, it's still fine, 8. Then we debit goodwill with 10,38. You are right. 10,38. 10,38. And then we'll move this line here for the 2 because we have recorded it under other components of equity. All right. Oh, well, let me just delete it. As you can see, this is how you'll be thinking through in the exam. All you need is to know the template, how goodwill is calculated, and then having corrected the accounting entries, which journal entries are required in the financial statement. So in the financial statement, we didn't have goodwill. Now we have it. That's our 10,38. And then, because we now have goodwill, we need to eliminate bargain purchase. No wonder why we debited it. And then contingent consideration was ignored. We take it up. There you go. And then NCI was ignored. There you go. That's the answer. All right. Let us proceed. Acquisition of March. On 1 January 2026, Kuchen acquired 80% of March, a privately owned entity, for a consideration of 57 million. The consideration comprised of 52 cash, 52 million, and the transfer of non-depreciable land with a fair value of 5 million. The carrying amount of the land was 3 million. And he has only recently been transferred to the seller of the shares in March and is still carried at 3 million in the group financial statements. Now, I want you to notice what the statement is saying. When we acquired March, we paid them cash for 52 million and we paid them land of 5 million. So you would notice that if the land that you transfer there's no difference between the land that you transfer and the cash that you transferred. There's no difference because both are your assets. You can either transfer cash or you can transfer land to acquire a company. But something peculiar about this now is the fact that this land had 5 million and its carrying amount in the books was 3 million. So what it means is, effectively speaking, the land was sold, and and Kuchen must recognize a gain on disposal of this land of 2 million, which is 5 million minus 3. Then at the date of acquisition, the identifiable net assets of March had a fair value of 55 million. March had made a profit attributable to ordinary shareholders of 3.6 for the year ended 31 December 2025. The directors of Kuchen wished to measure non-controlling interest at fair value at the date of acquisition, but again omitted NCI from the goodwill calculation. So this is an error. This is the error. they omitted NCI again. So NCI is to be valued using public entity multiple method. You know what this method is. It is better known as PE ratio method. That's PE ratio method, public entity multiple method, or PE ratio. So you simply say PE ratio times earnings. So what happens is our earnings were 3,6. So when we are valuing NCI, which is 20%, we are going to multiply 3,6 by PE ratio. So they are saying the directors of Kuchen have identified two companies who are comparable to match and who are trading at an average price to earnings ratio of 21. The directors have adjusted the PE ratio to 19 for the differences between entities and match. So in other words, when we are valuing match, we are not going to use 21. We are going to use PE ratio of 19. The finance director has determined that a bargain purchase of 3 million arose on acquisition, being the cash. Notice how they calculated goodwill now. They just say the cash of 52 minus fair value of net assets of 55. So again, they did not put NCI. They did not include the land which was transferred as part of consideration transferred. So let us answer this. Write this. Acquisition of, this is March now. Write this. IFRS 3 provides that land transferred as part of consideration. Land transferred as part of consideration must be included in goodwill calculation. Must be included in goodwill calculation, together with fair value of NCI at acquisition date. Together with fair value of NCI at acquisition date. And this, the land so transferred is deemed to have been sold. The land so transferred is deemed to have been sold at fair value. Is deemed to have been sold at fair value. And the acquirer must recognize gain or loss on disposal. And the acquirer must recognize gain or loss on disposal. Right? So, not so bad. What we are just doing here is write this. Goodwill, therefore, should have been calculated as follows. Goodwill, therefore, should have been calculated as follows. Right? So again, you say consideration transferred. So what you do is you say cash, it's 52. Then land. They transferred land as well. Land of 5. And then NCI is 20%, but they are going to use public entity multiple method. So it's like 20% times 3.6 million. That's profit. 3.6 times 19 PE ratio. So equals 0.2 times 3.6 times 19, 13.68. Then fair value of identifiable net assets. These are given as 55. Minus 55, sorry. So goodwill is 15.68. So what you then do is to focus on entries which were missing. Those which were recognized, there's no need. Take, for example, there was a bargain purchase of 3. So you eliminate that bargain purchase. There was goodwill, this one, 15.68. Right? And then NCI 13.68. Now, you do notice that there is land which we still record in our books, yet we transferred it. So we need to credit PPE, land transferred. Land transferred. Remember, in our books, it's at 3 million. So we record the year at 3. So you can see this land was at 3, but we transferred it at 5. So there is a gain on disposal of land of 2 million. So you credit gain on disposal of land, 5 million minus carrying amount of 3, and you get 2. Then if it is balancing, we check debits, 18.68. 18.68. Okay. The last journal is actually debit consolidated retained earnings. It's credit consolidated retained earnings. Right. So you are done. So let me again emphasize something. When you are looking for journal entries, all you have to know is to make sense of the figures that you have put across there. If we are saying there was bargain purchase, yet we realize now that there is goodwill, so we need to eliminate that bargain purchase. Instead, we debit goodwill. You get that? So there you go. Right. Then, so that was the answer to that question.
Sir.
Yes.
Sorry to take you back again. May you explain on land PPE why we credited the 3,000? The 3 million. I did not quite understand that part.
Oh, okay. Because we are told here that the land is still in our books at a carrying amount of 3 million, yet we transferred it. So we take out the amount we have in our books. The land we have in our books is 3 million. No wonder why we take out 3 million. But we then recognize that, it's like you sell an asset for 10,000 and in your books it's 4,000. You credit PPE with 4,000. You credit PPE with carrying amount, not with selling price. Then the difference now becomes gain or loss.
Okay, understood.
Right? Then continuing. Explain with suitable calculations how the gain or loss on the sale of niche should have been recorded in the group financial statements. Notice the question is saying how should have been recorded. So you have to calculate that gain or loss. Now, as before, we need to read the question first to understand what is it that they are talking about with niche, the last part here. I have highlighted it. Now, it's saying Kuchen had purchased an 80% interest in niche for 40 million on 1 January 2026, when the fair value of identifiable net assets was 44 million. The partial goodwill method had been used to calculate goodwill, and an impairment loss of 2 million had arisen in the year ended 31 December 2026. The holding in niche was sold for 50 million on 31 December 2026. The carrying value of niche's identifiable net assets, other than goodwill, was 60 million at the date of sale. Kuchen had carried the investment in niche at cost. The finance director calculated that a gain arose of 2 million on sale of niche in the group financial statements, being proceeds of 50 less fair value of 48. Right? And 48 was calculated as 80% of 60 million because net assets were 60 million and our share was 80%. So this is how they calculated the gain. That's how it was calculated. Right. Now question is, explain how it should have been calculated. Meaning they want you to tell them that the way they have done it there, it's wrong. When they say explain with workings, most students, you make mistakes of starting to work to calculate. If you look closely on the answers that I'm giving you, at no point am I starting by working. Remember, your subject is strategic business reporting. You are an internal financial consultant, financial reporting consultant. So you need to point out to directors to help them understand how they have made a mistake and how this mistake needs to be corrected. But in your explanation to directors, make sure you cite the standard. Now, the standard is what I gave you here. So we are now on gain or loss on disposal. So it's a matter of coming here. This is how you calculate gain or loss on disposal. Group gain or loss. Here. So, the examiner just wants you to say out that in words. The examiner wants you to say out that in words. When the examiner says, explain how gain should have been calculated. Then after explaining it, you then calculate it. So you're saying acquisition and disposal of niche. Acquisition and disposal of niche. This is exactly what I want you to do. The next question, I will leave you to do it on your own, just for practice. And I will send you the answer. Acquisition and disposal of niche. So notice I am explaining this in words. You know, for those who wrote SBR in September, 29 students wrote SBR and 26 passed it. And it was awesome. The secret is follow what your say is doing. When I say explain first, and then at some point then say applying the guidelines of the standard. This is how the gain should have been calculated. Once you do that, examiner already knows that you know. Not just right away we are already calculating group gain or loss on this. Oh, no. Can you imagine? You are reporting to the board. You can't present a report to the board which starts with a working. Just a working from Norway. Which type of board is that? Right. So write this. IFRS 3 business combination. IFRS 3 business combination states that in a disposal in which control is lost, comma, the group gain or loss on disposal is calculated as the difference between the group gain or loss on disposal is calculated as the difference between the sum of consideration received plus the fair value of any remaining interest less the fair value of any remaining interest less the fair value of subsidiaries net assets at date of disposal. Less the fair value of subsidiaries net assets at date of disposal. Net of NCI and any unimpaired goodwill. Net of NCI but including any unimpaired goodwill. Net of NCI but including any unimpaired goodwill. Net of NCI but including any unimpaired goodwill. So notice I am just saying out what is there. That's what I'm doing. Don't think that says so. What you need to know is to memorize this formula. This is where it is important. No wonder why I said this you should know it like back of your hand. Because your number one question, the 30-mark question for number one, it's on groups. So already you know, you already have 30 marks. Right? Write this. Applying the above guidelines, comma, gain or loss on disposal of niche should have been calculated as follows. Gain or loss on disposal of niche should have been calculated as follows. Right? So there you go. How would we calculate the gain or loss on disposal of niche? Right? So I have the template here. Consideration received. Let me scroll down. Consideration received. Consideration received. How much did we receive? They are saying sales proceeds was 50 million. So you put 50 here. Now, do we have any remaining interest? No, because we are told that everything was disposed. So there was no remaining interest. Where am I seeing that? Here. When they are saying the holding in niche was sold for 50 million. So there was nothing left. Then you say less fair value of net assets at acquisition date. I mean at disposal. At disposal. Fair value of net assets at disposal. Let me write them in the first column. So the fair value of net assets was 60 million. There you go. 60 million. And then you say less NCI in net assets. So notice, I'm just copying this format here. That's what I'm doing. After saying net assets, I'm now saying less NCI in net assets. Meaning we own it 20%, less NCI in net assets. Then you say 20% times 60. You know, you get 12. You could have just, instead of typing 60, you could have just said 80% of 60 and you write 48. In that case, this line will not be relevant now. Then goodwill. Add goodwill. Add goodwill. Now, goodwill is not given, so we have to calculate it. One. All right, so we skip a line. Let me skip a line and say workings. Workings. And one. Goodwill. goodwill. Right? So goodwill, they are saying they use partial goodwill method. Partial goodwill method. So you need to come to the notes and understand what partial goodwill is. So you come to the notes. I'm getting to the goodwill working. Here you go. This is partial goodwill method. Partial goodwill method, we said, it assumes that goodwill arising at acquisition is owned by the parent only. That's what partial goodwill method is. And when you are using partial goodwill method, NCI is not valued at fair value. Rather, NCI is measured using its proportionate share of subsidiaries' identifiable net assets. Meaning, when you are calculating goodwill, first find the net assets and then multiply by NCI percentage to get value of NCI at acquisition. Simple as that. So you simply say consideration transferred. Consideration transferred. Consideration transferred. All right. How much did we pay to acquire niche? We are saying he had purchased 80% of niche for 40 million. So we paid 40. So you put 40 here. You say value of NCI. Value of, this time you leave it blank, because under partial goodwill method you must first find net assets and then you multiply by NCI percentage to get value of NCI. So the net assets at acquisition, they are saying when the fair value of net assets was 44 million. So you say less fair value of net assets, less fair value of net assets, it's minus 44. Then NCI, now you multiply by NCI percentage. Simply saying 20% times 44. No wonder why we call it partial goodwill method, equals 0.2 times 44. So you can get the sum for this. All right. And then you have your goodwill. Goodwill. Goodwill, it will be equals this minus that one. So it's 4,8. But you check whether this goodwill was not impaired, because in the notes we have written on the top there, we said including any unimpaired goodwill, meaning goodwill remaining after impairment. That's what we mean when we are saying any unimpaired goodwill, meaning goodwill remaining after deducting impairment. So we are saying goodwill was impaired by 2 million. So there you go. So you say less impairment. What happened? right? Less impairment of 2. Then what you have is an impaired goodwill. Unimpaired goodwill. Unimpaired goodwill. Right? Add this up. So here you need to bring goodwill of 2,8 here. 2,8 like this. And then you say equals minus sum. You are seeing how I'm doing it on Excel. This is how you do it in the exam. Please. 50,8. So what it means is there was loss on disposal. Loss on disposal. Right. Loss on disposal of 0,8. Right. Then you are done. You are done. So what is required is, when you are answering these things, please learn to follow your notes. Don't jump some of these stages. There might be presentations which are different, because our notes cannot really capture exactly what BPP has put it. But believe you me, these notes are superbly special. You will not lose it. Now, what I want, this was CMAS lecture. All lectures, they end at 8:30. So I want to teach CMA, but because what we are doing today didn't require much of my time. No wonder why I then said at initial phase, let me wrap up what I wanted to cover yesterday. So this is what I wanted to cover. So what I want is to send, oh, do we still have people in the group? Ah, well, today is fantastic. At least I'm happy. Can you imagine if it was like yesterday, where, right? Allow me to send the answer to question number 3. Question number 3, please. As I said yesterday, there are instances where you need to play the last week's video before you can understand. You need to play the last, right? That's the answer to the Ashanti question. Follow through. Feel free to ask questions where appropriate, but I won't be able to answer you today. But just send any questions after going through the marking scheme, and you still find that you can't understand. What you do is, you first do the way I'm doing it. Go to your notes, understand your notes, because there's nothing which will be examined which is not in the notes, and then apply those notes to answer the question. You get it? So on that note, enjoy the rest of, allow me to send you pre-read material for next week's lecture. So the pre-read material is like this. You come to the lecture having read, but don't worry, I will explain everything as if nothing has happened. So its effects of changes in exchange rates. All right. So there you go. Effects of changes in exchange rates. That's the standard we are going to discuss next week. We do it in class and we finish it next week. We tackle it and complete it next week. Cheers, guys. Enjoy.
Thank you, sir.
You're welcome.
Thank you, sir.
You're welcome, guys.
Thank you, sir.
Thank you, sir.
You're welcome.
Thank you. Good night.
Good night.
All right. Let me also share my screen.